In this video, I want to speak about gold. Now, as usual, to keep the video as educational as possible, first I will be covering the technical aspect of this market. We will try to understand where we have the highest probabilities for the next potential move here on this pair. Now, starting from the monthly time frame, we can see that at the moment this market has just tested a very strong historical structure level. In fact, from here, all this previous move to the downside was created again here. The market tested its zone and rejected it to the downside. At the moment, we are once again testing that zone. However, in a situation like this, as we can see, the previous times the market went for a way deeper test of this zone. So what we could expect is a deeper test of the area, meaning some short-term bullish price action before then getting a potential rejection to the downside. Going down on the weekly, what do we see? Now, from a weekly perspective, we can see how we had this impulse and correction. Now, after this impulse and correction, when the market was here, I made a full breakdown explaining all the reasons for which we could expect a rejection to the upside, which is now exactly what the market has given us. And by the way, I will link in description that previous analysis so you can go and check it out for more free education. However, as the market has now created the impulse, if we want to measure the correction, what we have to do is take our Fibonacci from the low to the high of the impulse. And if we do that, we can see how we have a perfect 0.786 Fibonacci retracement, which is also lining up with previous resistance turned support, creating a confluence of support at this area, which we could in fact expect the market to test and then to start to reject to the upside. Dropping down on the daily time frame, what do we have? Now, from a daily perspective, what we can see is that we just got a very strong impulse to the upside starting from this low. We had a huge impulse to the upside. At the moment, the market is starting the correction. Now, in general, after an impulse, if you want to measure the correction, you have to take your Fibonacci from the low to the high of the impulse. And if we do that, we can see how we have a 0.32 and 50% Fibonacci retracements currently lining up exactly with this previous level of resistance, which is now turned support, creating confluence of support at this area, which we could in fact expect the market to test and then potentially to reject to the upside. Yes, where we're starting to see a decrease of the net positioning, we could expect a bit more bearish price action, at least in the short term, but in the long term, everything seems pretty bullish. So if we will see a deeper test of this support that, as we have identified previously, is all across this area, during this test, how we could be approaching a potential reversal to the upside for the market to go for a deeper test of the monthly resistance that we have previously identified at the beginning of the video. Now, as usual, trading is reactive and not predictive. The monthly, weekly, and daily, those are the best time frames from a directional perspective. However, when it comes to confirmations and entries, the best time frames are the intraday time frames, so 4 hour and lower. Therefore, what we could be doing, potentially also with students, is monitoring price action from an intraday perspective during this move to the downside, waiting for the market to shift from an intraday bearish market as we would have to an intraday bullish market. And if the market would shift from an intraday bearish to bullish market and provide to us one of our valid entries, at that point we could be looking for a potential rejection to the upside for the market to complete this impulse correction and impulse pattern to the upside. Now, if you enjoyed this free analysis education and update, make sure that you drop a like and a comment. It really does support the creation of more free analysis education and updates for all of you, and I will see you in my next breakdown.